As we all know, the stock market is in a bit of a correction mode here. I've been saying for a while, and this isn't really meant to be an I told you so moment, although it sort of is. I've been saying that there's a risk to deflation and a recession, and that would be evident with my lower for longer thesis with regard to the Federal Reserve and their monetary policy. And this week I started hearing a lot of people talk about the lower for longer thesis, and I've written an article on that. It will be in the link below this on the YouTube broadcast that will follow. And the lower for longer thesis is basically comprised of a few components, and this is really important stuff to really understand, because then you'll understand what's going on with the overall market. So I've been saying for a while that the global growth picture and outlook has been slowing, and particularly here that we've had this stall speed GDP. We've had the lowest labor participation rate since 1978. The durable goods orders have been bad. The commodity prices around the world, particularly oil, have been in crash mode. And the only market that has been kind of holding up really well is the United States. You've had Brazil, Russia, India, and China all down severely. We hear about China daily. And China is sort of the end market for a lot of these products that our companies here produce, like the Nikes, the Apples. This is where their growth is after being in a saturated U.S. market. So as these countries are trying to combat their own slowing growth, they are deflating their currencies and artificially making the dollar more expensive, and that has been hurting the earnings of companies like Facebook and Apple and Nike and any company that does business overseas. Now the dollar, I can see, I'm looking at the dollar chart, is backing off well from the downtrend. It's still really in a consolidation pattern, but it is backing off the highs, and it's backing off fairly well. I think that is because the market is starting to realize that the Fed isn't moving in 2015, and if this continues, might not be moving in 2016 either. That's a bit of a bold call here, and I'm not really ready to make the 2016 call just because there could be some pattern reversals. But the way I'm seeing the economic data that's coming in, there is no reason for the Fed to have to combat any inflationary fears. And I'm sure they'll start with this transitory BS, but the truth is that the economy is not well, and the markets are starting to realize this. In the Fed statement the other day, there was a knee-jerk reaction to the upside if you looked at the SPY, and that was one that I think we'd covered pretty well, that I thought that if we were down into the Fed, I thought there would be some type of a pop. But the pop didn't hold, and that was because traders realized that the Fed was really downgrading their economic outlook for the U.S., and in that downgrade, that means earnings estimates have to come down lower. I want to talk about a couple of stocks, and I think this will show you why the markets are coming down. So someone mentioned Home Depot. Let's pull up Home Depot here. Home Depot is, we all know it, they have the stores, the housing market has been doing, I guess, better, and that has been one of the reasons why Home Depot has been thriving. But if you take a look at it, the stock kind of had a big move up, and then after earnings, it's been down. If a stock can't go higher, it kind of had a bit of a gap up, which was a bit of an island reversal. It sort of had like a couple of days of that, 2-3 days of that, and then today really took it back. If a stock can't go higher on good news and it can't hold that, there's only one place for it to go, and that is down. Now, someone had messaged me today, actually, I don't want to mention any names, but someone had mentioned me and asked if it was time to buy Home Depot for their IRAs. And I had said that the stock is like barely off the highs. The market's been in correction. I mean, if you're looking for some type of a long-time buy, I mean, Home Depot isn't really even down that much. The pattern is reversing, yes, and the stock is still kind of in a bit of, it has not even tested its trend here. I mean, the stock is barely down. If you take a look at companies like, and I've been saying that this was going to really start to matter soon, if you take a look at the chart in Disney, for example, that stock is starting to trade like a biotech stock, going down in huge swaths. I mean, a company like Disney doesn't trade like this normally, and the stock is down ginormous. I mean, it's down to almost a 78.6 fib retracement of the recent range. It's about almost to a 61.8, believe it or not, of a larger range. And that, to me, in the 94s and 95s is roughly the gap fill, and I think that that will be a tradable low for a right or right out long for a bounce. But this is a stock that is getting absolutely smashed, and these are stocks that really matter to the market. I mean, these are huge Dow components. They're big components in the S&P 500. And I believe that, you know, there is, believe it or not, still some risk still lower. This move down is really just a first leg of potentially a three-wave move in the markets. And those waves get real ugly, really fast. I will say this, though. There will be opportunities if you're kind of buried to kind of unbury yourself a little bit if we are to continue lower. And I'm going to discuss that in a minute with the S&P. Before I do that, though, let's take a look at Exxon, for example. Another really huge component in the Dow, another really big S&P stock, one of the most valuable companies in the world, the second most valuable company in the world next to Apple, and is been absolutely getting destroyed. I had said the other day that I thought that the economy was not well and that ExxonMobil was a good key to that. And if we're below 83, there's risk to more deflation, and we are well below there. The stock is, you know, closed today at 72. It's below its 61.8 61.8% fib retracement. And I would say at this point, you know, maybe it could rally back up if the market, you know, wants to reverse and retest that breakdown point. But the stock looks pretty weak here. That is one I am looking to do some IRA buying in, maybe a little bit lower. Let's just address the elephant in the room, and that's the S&P 500. So, someone had asked me on the stream today if today had a lot of technical damage, and the answer is absolutely. This was a debacle today. We gapped and went, and we closed almost on the dead lows of the market. We closed basically on a 50% fib and at some reference lows, down in 197s. And it was interesting that 200 was just sort of a stumble step, as was the 201.92. The S&P basically broke to the downside the up channel that has been in place since 2011. This is very, very bearish price action to kind of just go. It tried to have a little bit of a bounce early on in the day. It could not do it, and it was just lights out after that. I think it triggered a lot of technical selling. It ran a lot of stop losses. You had shorts piling on, and that was sort of all she wrote for today. It would not shock me to at some point see a rally back up, maybe to try to test, you know, the backside of that breakdown. But for me, as is, was a significant breakdown, and it has me thinking, until that sort of damage can be corrected, that we're maybe in a sell the rips type of a market now. I would say that there is potential for the market to rally back to 204 in SPY, but I believe that area will now not be support anymore, and it will be resistance for shorts. If we do continue down early next week, you know, markets don't bottom on Fridays, and this was no bottom by any means. This was a vicious sell-off. It wouldn't shock me if there was some type of a relief rally if China doesn't, you know, kind of like soil its diapers on Sunday night, there could be some type of a rally, but it wouldn't shock me to see a little bit lower still. There's a big 61.8 at 194. I believe that area will be an interesting right or right out type of a position, but there is potential to come down and fill yet another gap down to the 190s. That is a lot of movement really fast. It is actually priced into the options. The potential move in SPY, believe it or not, given the close in the VIX that was really quite astronomical, SPY is factoring in a $9 move next week, $9.34 to be exact, and the IV in next week's options is 40. The week after, it's 30, and it's roughly about the same type of a move. I guess everyone was buying next week's options as protection, but that is factoring in quite a large move still lower. There are some gaps, like I said, to fill down there around 180, 190 and 186, and it is possible that we do get down there on some type of a continued panic flush. We won't. I can't answer which is the kind of the order of operations. If we're going to see those lows first, or if we're going to see the bounce first, that's always tough to tell. I will tell you this though. We closed really quote unquote cheap today. Yesterday we closed about $23 below the volume weighted average price, the VWAP. And today we closed almost $30 below the VWAP. That is it was like $29 and change. We closed below there. That is really far and extended from value. The volume today was pretty high. I think there was a lot of flush out, so there might be some type of still move lower and then a bounce, or if we get the bounce would be, I think, to short. So that's sort of what I'll be looking for on Monday. I'm going to discuss this in a lot more detail in my Sunday video. If you're not subscribed to my YouTube channel, you probably want to do that. It's Justin Pulitzer Trades. I'm going to go over these charts in some detail and show where I think things can go in either direction, either for the rally higher or for a continued sell-off lower. Take a look at Apple. That's one that is on the list here that people wanted to discuss. That stock got absolutely demolished today. It was down to in the 105s, down almost $7, $6.89 on the close. I see it's bouncing a little bit here in after hours. I think a lot today had to do with some options pinning, but Apple got murdered. I've been talking about with Apple that I think we can see some reference lows. There are some reference lows here around 104.63. I don't necessarily know if that's going to catch Apple. It'll probably do something stupid like bounce ahead of time. These stocks have been causing them their own problems by rallying ahead of the time when they should be checking back to stronger support. When I was on vacation a couple of weeks ago, I discussed this and I equated it to a slingshot. And if you pull back a slingshot to only half cocked, when you let it go, your projectile will go farther, but it won't go as far as it would be as if it's fully cocked back, like a full pullback. So I think that that's been the problem for these limp rallies, that we haven't been checking back to the proper supports. Now, where will that be in Apple? Now, 100.72 was the split-adjusted old top before the old 30% correction. There's also trendline support a little bit lower in the 10. It's almost 102 now. It's like 10 in the 101s. I do believe that there is some support given some reference breakouts from the past around 103s. So I think somewhere between 103 and that 100.72 should be a really good area to kind of buy the dip in Apple, or to at least sell some out of the money puts for a bounce. Now, there's a Apple VIX. That VIX today got up really high in terms of the pricing in Apple options. I don't want to get too wonky with it, so I'll give you something that you can look at if you want to see where Apple's volatility is priced. If you just look in the options chains, Apple's IV is normally about 25 or 26. The expected volatility for next week is almost 58, and the one for this, even for the September expiration, is 49. That is jacked. I mean, really jacked. They have a product release coming in September, so I do think that there should be some type of a bounce ahead of that event. If they keep selling into the event, though, that could set up for a really good reversal pattern. In the bigger picture, Apple, believe it or not, if the market is really going to go into full-blown bear mode, the larger Fibonacci retracements for Apple, the halfback from the entire move is 95, and the 61.8 from the larger range is 85.72. I know it sounds crazy, but this is very, very possible on some type of forced liquidation if the market is going to go significantly lower. I do believe it will happen in stages. I will be a buyer on that trend line and that old level, roughly between 100. It might overshoot a little bit to kind of run the stops, but I do believe close to 100 will be a good area, at least at the very least, to sell some very near-dated, out-of-the-money puts for some type of a bounce. Amazon, that is another momentum stock that has been getting its clock cleaned. It gapped up. You know, I mentioned this week, by the way, I had some problems with my platform. My charts got kind of wiped. I haven't really redone Amazon, so I'm going to be doing that on the fly here. But I will tell you this: the big beef, I think, that Amazon, what it's really suffering from, was that it rallied ahead of the earnings and it gapped up, and people used that gap to sell, and we are now below that big kind of reversal, that big kind of gap reversal day bar. There was some consolidation. It held the 20-day moving average for a little while, and now we are filling that gap. It's almost completely full. If you're looking for a intraday day trade with Amazon, the 50-day moving average is about 481.76, and that's roughly around the gap fill. I think that could be just for maybe an oversold bounce. But I hate to say it, we may have a top in Amazon, and it may be a top for a very long time. I just don't really see with the market this week how Amazon is going to really rally back up. The truth be told is the best thing that could happen with this stock is for it to do some type of a larger correction, and then you could tell I'm tired. I'm sorry if I'm almost yawning. It's a Friday. It's been a long week. I could tell you the best thing that could happen is these stocks have some type of a larger reset and set up for the fourth quarter. Maybe we get a a buy. Maybe we do get a look at Amazon, back down closer to 400. That would be something, right? We'll see. Like I said, in stages. You always have to think in stages, time frames. One of the biggest mistakes I think people make is that they look at the chart and they sort of just assume either the best case or the worst case scenario, and they forget there are levels in between. No, unfortunately not enough partying, although maybe this weekend. Alright, so we're done with Amazon, we finished SPY, we did Disney, we did Apple. Let's discuss some Netflix here. So Netflix also, I had discussed a couple of days ago that there were kind of two reversal hammers, like almost tweezerish tops up in the 129s. And that is doing basically what Amazon did. It didn't hold the 50-day. It closed below there. It actually closed below the pullback low from the range, which was 206.90. Today was a close at 203.96. That's pretty bearish. I would say that there's going to be some type of a relief rally in these stocks at some point. There will be a bounce. They don't just kind of go out easily, but I'm still thinking lower with this. I think this stock kind of blew its brains out. It rallied. It's just been rallying and rallying. I think that the media, if you turn on the TV, all they do is talk about how there's like a love affair with Netflix. I remember when they were talking about a nuclear winter for this stock a few years ago, and they were going to be splitting the stock up, and they were talking about splitting it into two separate companies, like crazy stuff. So I would say, yeah, I'm a Netflix bull longer term, but in reality, these stocks aren't even down that much. I mean, when Netflix got this rally going, believe it or not, a couple of years ago, it was $45. the stock just topped out at $129. You know, I mean, it's still $103. So it wouldn't shock me to see some type of a bigger pullback. You know, the breakout for this stock, believe it or not, was still back down at like $70. So, you know, this thing has not really tested back to any levels. I had mentioned the other day on that put ratios were a good trade. I hope those worked out for people. I covered Exxon. Tesla, let's just cover that one really quickly because it's so easy. Elon Musk came out. They did a secondary. The stock rallied. His buy-in, he did like $20 million. It was 242 was the buy-in level, and anything below there to me is more bearish. I do think that we're now making lower lows from lower highs. It closed just above the 200-day. I wouldn't be shocked to see 221.85, which is the 61.8 fib. If the market really wants to give up the ghost, we could see the 205s and 203s, somewhere around, let's say between 203 and 206. In that area, that's the primary trend. Not saying that necessarily happens, but if Tesla is below that 242 secondary, you don't want to be long it. Above it, you can be long. Below, no long. It's that simple. Really, really simple. We saw something like that. This isn't a stock you guys wanted to discuss, but I'm going to talk about it anyway. Shake Shack, they did their secondary. The stock also had a gap and crap, and now it's back down, kissing below the last pivot, the last swing low. That low was 48.21. Today's close was 47.5. So, yeah, oversold short term, could bounce, but it wouldn't shock me to see that thing back at 38s. And at that level, I would reassess. I'd probably be a buyer for a bounce, depending on how it got there. The best way to me would be sharp and fast, and not, build the inventory overhead so much. That's been the big problem with the market this year. We've been working off. I'm back on the SPY chart here for a minute. We've been working off the excess from 2013 and 2014, and the market has been in a sideways consolidation pattern for a long time. Anyone who's bought this market since October basically is now wrong. They have been paying higher prices, and the market is now lower. So as the market would bounce back up, they would likely want to get their money back. And the middle of that range, like I've been saying, is somewhere between that 204 and 205s. I think that area there is going to be it for a while, and could be a good area for right out shorts if we even can bounce that high. I suspect we may need to see lower before higher. Sorry to jump back and forth there a little bit, but I wanted to give I wanted to kind of tie it in there a little bit. One of the main culprits in the reason for the decline in the market has been energy stocks. And if you have been living under a rock, you don't know that oil is down ginormous from 110 or 15 or wherever it topped out, and it's now kissing 40. It's struggling to hold 40. I had discussed a primary trend as being supports. They had worked, and now we're below there. There are some reference levels here, though. The 2009 and 8 crash low in oil is down at 33.20. There was a breakout in that area also around 37. So I do expect there to be some support there if and when we get down there. If I'm just looking at the stochastics on this thing, it is as bombed out as can be. It also wouldn't shock me to see some type of a gap that no one expects, that gaps above the downtrend, and then that's sort of the end in oil. Maybe there's some news, the Saudis cut production. I think the reason why we've been seeing the weakness in oil is, obviously I discussed how China is slowing and global economies are slowing, Europe as well. The lower price of energy will be good for countries and their GDPs and their growth, but in the short term it is deflationary, and it means that we've been hit with a combination of things. One is there have been tremendous advances in fracking and horizontal drilling in the last few years, and we now have more supply. Plus the Saudis are trying to supposedly maintain market share and kind of bankrupt some of the peripheral companies that have been giving them competition. I guess they figure short-term pain for long-term gain. You also have a potential deal with Iran that could potentially put millions of barrels of oil onto the market during the day, per day. And you have the combination of the supply and the slowing growth is not good for the prices in oil. So it has been coming down. As that is happening, it is smashing a lot of very good high-quality companies. There's been a lot of Chevron had reported their earnings, and they were really not very good. And I think there's a lot of fear. I heard Jim Chanos, for example, on TV today that he thinks that some of these companies are going to cut their dividend. If that happens, those stocks are going to get smacked again, and then you probably can buy them after they shake out. That, to me, would probably be the good area low to buy. But the weakness in oil has got everyone freaking out and thinking deflation. I've been saying this for a few weeks with the lower for longer, that deflation is the real problem, not inflation. I don't want to get on my soapbox and preach too much with this, but and I'm going to sound too much like Trump now. We have incompetent leaders who have not done anything to fix the real economy. They have given companies bailouts, and they have not fixed any of the products that they create, meaning General Motors still builds cars that people don't want, and they have done nothing to improve the kind of balance sheet of the U.S. All they've done is pile on debt. And why not? It's been so cheap. They've been able to borrow for nothing from the Fed. A lot of companies have done that as well, and they've been buying back stock, and they've been paying out dividends. They have not been hiring. They have not been innovating. There has been no capital investment in their businesses. So you have a rotting infrastructure of the American economy and businesses. I know you're not going to hear this on financial news, but this is the damn truth. And until that's fixed, we are going to be in this Frankenstein market where we are dependent on low interest rates. The good news is that we're going to have them, and we're probably going to have them for a while, because as the world kind of melts down, rich people in foreign countries that don't have federal deposit insurance put their money in the U.S. The best way to do that is they buy the bonds, they buy CDs, and they eventually will buy some stocks. What helps them is if they have initially there is some pain, though. You know, there has to be sort of that deflation before the reflation. In the end, the U.S. always winds up being the winner when you have these kind of contractions in global growth, because we're the reserve currency of the world, and there's no safer place to put your money. Amazingly, we'll pile on debt, and we'll have a higher percentage of debt to GDP, and it won't matter initially. It doesn't matter until it matters, believe it or not. That sounds crazy, but it won't matter until it really matters. And it's mattering in Greece, it's mattering in China, it's mattering in Russia, it's mattering in Brazil. Brazil also, by the way, is amazingly how these countries have come down. If you look at EWZ, they are now below the 2009 crash low, amazingly, past the 78.6. I actually, this week, just the other day, I guess yesterday, so I guess it was a little bit early, I actually took a little bit of a nibble in that ETF. Nothing major, just a little tester. Fully recognizing that it'll probably go lower. Believe it or not, the low that this rallied from way back in the day was $5. So if they don't kind of catch it here, I'm really not sure where they're going to catch it. It'll be significantly lower. Speaking of China, the FXI is continuing its slog down. Alibaba is now back to the IPO price, like I had discussed I'd be afraid of, on the break of 80. We're now down at 68. I did discuss that discipline and how I avoided a real shellacking in that one in the last video. I've been playing that stock long and short. Now I'm just not doing anything with it. But I got stopped out on the break of 80. I've never looked back, and boy, am I happy. That thing is just a piece of junk. Anyway, sorry to get distracted there. With regard to the FXI, 3610 is the 50% fib, a little bit lower than that. 35s is primary trend, so it wouldn't shock me to see a little bit of a bounce there, particularly if it's a gap. I will start nibbling and buying this at 32.15-ish. That's the 61.8% Fibonacci retracement of the entire move in China. Amazing that that would be the case. It would be even more amazing if it coincided with our 61.8 of the range and down at 194s. I don't even want to talk about what the 61.8 of SPY would be if we want to go for the entire move like we were discussing in some of these other stocks from the 2009 low. I don't think that is really relevant to discuss at the moment. It's really, really far down though, so let's hope we don't see that. I would really not so much saying hope because I hope the stock market stays high, but for the good of the country, I'd really rather not see it have to go through that type of an economic convulsion again. It's gone through it. Sorry, I just had a call come through. I hope that didn't bounce me out of Periscope here. Could you guys still hear me? Just someone say something? I see the hearts going, so I think it's okay. I'll assume it's okay. Anyway, one of the big problems for SPY, and I've discussed this for a while, is that it has never checked back to the 155.75 breakout from the 2000 and the 2007 tops. We've gone through there. There was like a one-day check back or a one-week check back, and then it's rallied back up. My big fear for the market is that we do revisit that level. That would be a lot of pain. It would take a while. I think that it would be a disaster. Amazingly, it wouldn't be that big of a deal technically, but with regard to prices and where a lot of people have been involved in the market, I think it would be pretty ugly. So I am mindful that I think eventually will happen. I don't know that it's here. I don't know that it's this year. I don't know that it's in the next 5 years. But I do know that at some point that there is some potential for that. So just be mindful. You know, everyone's like, oh, you know, I was listening to one of the news reporters on TV today, and they said that they were seeing, you know, capitulatory type of panic selling here, and you know I guess we're back to a 50% fib of the range here, and that you know. Yeah, that's true. There was some panic selling into the close today, but the big problem is that today is really only day 2 of really heavy selling after being basically from an all-time high. There is a lot of room for the market to drop. Just realize that when markets get squirrely and there is an asymmetry to the downside, that meaning that the sort of escalator or stair step up leads to an elevator ride down, that markets can go lower for longer and further than you think is rational or necessary or even possible. It doesn't have to do with anything logical. It often has to do with necessity, meaning that people are overly long, they're overly levered, they're overly extended, and they must sell. And when something can't go exactly, see oil. If you take a look at oil, that could eventually happen to the stock market. That is the big fear here. I do believe that the Fed is mindful of this. I don't think, like I said, that I think we will see some type of a rally back to the breakdown area at some point before we kind of really have a danger of a major collapse. Like I said, it's usually the break, the check back, and then either it accepts to go back higher or it's the big wave down. So this is sort of, you know, I got a call today from a reporter from the gentleman who wrote the article about me in the Wall Street Journal a few months ago, and he was asking me today after the close my opinion. That's actually the reason why I got started a little bit later here on the broadcast. And I told him that as bad as this move feels, this is just a love bite. Like, this is just like a slap on the wrist compared to what could happen in markets if things get really get moving to the downside. It's a little bit early to say that we are in, that the top for the market forever or for the next, whatever, how many years is in. But It's not looking good. Like I said, we broke below trend. We're below these levels, and I just really want to keep people mindful. And I've seen the pain with the questions I've been getting asked, and from messages I've been getting from people. Just keep your I guess position sizes, and I've been saying this all year. Smaller position sizes. Look for smaller swings. And look to keep your time horizon short, particularly with premium selling. Don't do the monthlies. You want to do a week, maybe two, max out. That is, when a tape gets fast like this, a fast market, things can get really elevated. We are in a very precarious spot with the VIX. I have been saying that I posted some ranges on the VIX. And it closed today at 28, which is really a lot. Anything above 25, there's always a little bit of give to, I guess, 30, because we've seen that in corrections before. But anything above 25 has crash risk on the table. You got to be real careful with that type of a situation. It's a very precarious setup. Like I said, I do think we are very oversold short term with the sales away from value, but bigger picture, the market is still really rather overbought. Anyhow, I'm going to leave it there for now. I will discuss a lot more of this in my with the charts, which makes it easier, in my Sunday video. Like I said, follow me on Twitter. My handle is @JustinPulitzer. My YouTube channel is Justin Pulitzer Trades. I think you'll find that information very useful. I'm going to do some adjusted levels and where I see things potentially going in a kind of a look below scenario and rally back if we're gonna if we are gonna get the blow off top, or if we have a complex top that formed and we are going to be going lower. I'm going to discuss how I see that playing out. Anyhow, let's have a good weekend. The summer is kind of winding to a close here, so enjoy the beach and get some rays if you can. Try not to worry too much about this until at least Sunday night. Anyhow, adios, guys. That's my story. I'm sticking to it, and cheers.